Welcome, everyone, and thank you for joining us today. My name is Rick Maduro, and today we're going to discuss one of the most overlooked financial risks facing restaurants: sales and use tax compliance. Restaurants today process transactions through multiple systems, including POS platforms, credit cards, online ordering, and delivery apps. While these technologies help businesses grow, they also create new reconciliation and reporting challenges that can increase audit risk. During the next 30 minutes, I'll show you some of the most common issues we see, the audit triggers that attract the Department of Revenue, and practical steps you can take to improve your records and reduce your exposure. Whether you're a restaurant owner, manager, bookkeeper, or accountant, my goal is for you to leave with actionable ideas you can begin to use immediately. Let's get started. Common audit triggers. Many restaurant owners believe audits are random, but that's usually not the case. Departments of Revenue use technology to identify businesses with reporting inconsistencies. When your sales, bank deposits, payment systems, or tax returns don't align, it can trigger additional scrutiny. Some of the most common audit triggers include sales that don't match tax returns, bank deposit that don't match sales, unreconciled payment system, frequent return adjustments, unusual financial ratios. Lastly, withdrawing large amount of cash out of the bank account. The good news is that most of these audit triggers are preventable. With proper reconciliation and strong internal controls, you can significantly reduce your audit risk. Multiple payment systems. Today's restaurants rarely have just one source of revenue. Sales may come from Toast, Clover, or Square, while delivery orders come through DoorDash, Uber Eats, or other platforms. Each system reports sales differently and deposits money at different times after fees are deducted. If these systems aren't reconciled together, the numbers on your sales tax return may not match your actual sales. One of the most common issues we find is that restaurant owners rely only on bank deposits instead of reconciling all payment platforms. That's why reconciling every payment source is critical for accurate sales tax reporting and reducing audit risk. Okay, much better. Sales versus deposits. Understanding the timing differences. One of the biggest misconceptions is that sales should always equal bank deposits. That's not always true. Credit card processors and delivery apps often deposit funds 1 or 2 days later and deduct processing fees before the money reaches your bank account. For example, if you have Monday POS sales at $10,000, but the bank deposit is saying $8,750, there's a $1,250 difference, but that could be caused by funds depositing the next day, credit card processing fees, delivery app commissions, or some other timing difference. The key is documenting and reconciling these timing differences so that they can be clearly explained during an audit. Okay. Common errors. Many sales tax assessments aren't caused by fraud. They're caused by simple reporting mistakes. Some of the most common errors that we've seen include Taxability. Not all food or beverage sales are taxed the same way. Exemptions. Tax-exempt sales should be properly documented. Discounts. Coupons and promotions can affect the taxable amount. Delivery fees. Whether delivery charges are taxable depends on your state rules. These errors may seem small individually, but over hundreds or thousands of transactions, they can result in significant assessments during an audit. The best practice is to understand your state sales tax rules and consistently apply them. Audit readiness. If the Department of Revenue requests an audit, good records can make the process go so much smoother. Every restaurant should retain POS sales report, daily cash and credit card summaries, bank statements, sales tax returns, delivery platform reports like DoorDash, Uber Eats, Stripe. Stripe is another one that some restaurants use. And of course, you may have an in-bank system that you're using. Vendor invoices and purchase records, they are so important. And lastly, exemption certificates, if applicable. That can be a really huge part there, because you may not owe taxes due to some exemption that you may have. Monthly health check. Don't wait until you receive an audit notice to review your records. A monthly reconciliation process helps identify issues early while they're still easy to correct. Each month, compare POS sales to bank deposits, delivery platform reports to POS sales, sales tax collected to sales tax reported, vendor purchases to inventory and sales. Think of this as a monthly health check for your restaurant's sales tax compliance. Finding and correcting small issues each month is much easier than explaining them during an audit. Next, case study. We're currently finishing up a sales tax review audit with this company. They had multiple revenue streams, multiple payment system, but they lacked a consistent reconciliation process. And now they owe thousands of dollars in additional tax penalties and interest. All of this can be avoided. As the business grew, it failed to implement internal controls that kept pace with its operations. Sales flowed through the POS system, credit card processors, online ordering platform, delivery apps, but there were no consistent monthly reconciliation process to verify that all systems agreed. Instead of using these systems to strengthen the business, management relied on incomplete information and never established procedures to identify discrepancies before filing a sales tax return. When the Department of Revenue began its audit, the restaurant was unable to fully support its reported sales. The result was thousands of dollars in additional tax, penalties, and interest, along with a lengthy and time-consuming audit. The lesson is really simple. As your restaurant grows, your accounting controls must grow with it. Technology alone doesn't prevent audits. The reconciliation process does. What you receive with a complimentary assessment. We offer a 30-minute 30-minute comprehensive assessment. We'll review your current POS system use, payment methods, credit cards like DoorDash, Uber Eats, the sales tax filing process, number of business location, current bookkeeping and reconciliation process, recent Department of Revenue notices, if any, will identify 3 to 5 potential audit risk areas, and then we'll produce a sales tax risk score, low, moderate, or high. And then finally, the actual engagement will give you a comprehensive sales and use tax risk assessment, POS and payment platform reconciliation review, bank deposits and gross receipts analysis, sales tax return review, identification of potential audit risk, and written findings and recommendations report, and of course, a one-on-one review meeting. Now we'll open up the presentation for questions and answers. Hey, hey, Corey. Well, thank you for joining us. That is the end of our sales tax in use review for restaurants. If you are currently interested, click on the link before. I urge you to take the complimentary review first to see where your restaurants stand, and then we'll actually go from there to see if you need anything else. Thank you for joining us today. And we look forward to working with you or your restaurant going forward. Thank you and have a great day.